Okay, great. I think we'll get going anyway. And if people keep joining, they keep joining. So good evening, everybody, and welcome to our investment webinar. My name is Claire Hanrahan. I'm joined by Stephen Dixon and James Forbes. I'll give you a little bit more background on Stephen and James in a moment. So just to give you an idea of what we're going to do this evening, and a little bit of background. So traditionally, we used to do our retirement webinars, our retirement seminars in the Westbury Hotel. And about a month later, we'd have the opportunity to invite maybe 15 or 20 clients to find out a little bit more about investments. So we did a retirement webinar about a month ago. It was really well attended. So we said we would do a similar thing, an investment seminar, and we've been blown away by the amount of people that wanted to attend. So, I mean, I think one great thing about the pandemic is, you know, we've people up and down the country logging in the comfort of their own homes this evening, when typically, you know, they wouldn't be able to come into Dublin City Centre, and we were quite limited as to the number of people that we could invite along to this. So yeah, that's really kind of, we're really, really happy with that. So I suppose before I kind of give you an overview of the agenda, I just want to kind of give you a few kind of bits and pieces of what's going to happen this evening. And this is a Zoom webinar, so everybody is automatically, there's no, we can't see people's screens apart from the speakers, so you're all muted. But what we have done is, when we were registering people, we were taking your questions for the evening. So Stephen and James, they know the frequently asked questions that we got from our attendees, so they're going to touch on those when they're going through their presentations. As well as that, then, you know, we'd recommend you take notes. Our marketing manager, Sarah Connolly, is going to send you on the slides as well tomorrow after the seminar is done. And if you have anybody who can't attend this evening, you know, we can send on a link to rewatch what we're going to speak about also. We're also going to have a little bit of fun. We have 3 1-for-all €100 vouchers to give away. So each of the speakers is going to do that. How we're going to do that is we're going to, you know, give a question, and then the first person to answer on the chat function, you know, will win that. So we're just going to open up the chat function just so everybody can, you know, make sure they know how to use the chat function and say hello. So Sarah, do you mind just opening the chat function there? So
yeah, we're open there now, Claire.
And so people can just type in hello or good evening or whatever it is. Yeah, great. So that's the way we're going to do that. Okay, so that's just a little bit of an introduction to what we hope to achieve this evening. So I'm going to, without further ado, just going to go through the agenda and the speakers. Great. So as I said, my name is Claire Hanrahan. I'm a partner with Irish Pensions and Finance. So I'm going to start off and give you an overview of our investment advisory process. So once I'm done, then I'm going to hand you over to Stephen Dixon. He's a regional sales manager with New Ireland Assurance. He's going to talk to you about assessing your appetite for risk. So we hopefully have sent out everybody a risk questionnaire in advance of this. So he'll be talking to you about what that actually means. And then James Forbes, he is the head of investment solutions for Goodbody Asset Management. He's going to talk to you about understanding the fund categories available. So that's the lineup for the evening. I suppose it's just to give you a look under the bonnet at investments. And then following that, I suppose, you know, your own specific questions we will be able to answer in your review with your financial planner from IPF. But I do think one of the main things to think about when, you know, embarking on a decision like an investment is just to take your time, get all the information and take your time. I think that's really, really crucial. Okay, so I'm just going to kick off. I suppose, you know, when you received the overview of what we were going to do this evening, I think it's nice to find out where myself and Stephen and James, where our companies fit into the picture for yourselves. So, you know, because you're kind of thinking Irish Pensions and Finance, what do they do? And New Ireland and Goodbody. So just to give you a kind of an understanding, we Irish Pensions and Finance, and I'm going to give you a little bit of a background on who we are a bit more in a moment. We're your broker. So we will sit down with you, do the financial review, give you the advice. Following that, then you have New Ireland. So they put the solution, for you together. So they'll bring all the products and bring them together and wrap them up for you. And then following that, then it's companies like Goodbody who actually manage the money. Okay. So that's the kind of, where we all fit into the picture. Great. So I'm just going to talk to you about the advisory process. So just a bit of background, Irish Pensions and Finance, a lot of the people logged on here this evening are already clients, but just a few figures and facts about who we are. We were established in 1993 by Owen Dwyer. He's our senior partner and founding partner. And there's some figures here actually we're really proud of. We've over 25,000 policyholders. We've 3,500 retired clients, and actually it's probably, you've asked any of the advisors, it's one of the best parts of our job is getting people to that end process when they're retiring and helping them through that journey. We've over 600 million in funds under management. We're an authorised advisor. So what does that mean to you as a client? It means that we aren't working for any one institution. We are working for you. So we're not tied to anybody, so we have a free market option for you. We have a team of dedicated financial advisors qualified to look after you. We have a really experienced back office staff. It's something that we're really proud of. All the people you'll speak to, they're qualified within the financial advice area. And Alonso, one other thing we have is a retirement help desk. Actually, that's unique to Irish Pensions and Finance. So I'm going to give you details at the end about, how you can actually use that. Okay, why invest? These are just a few things to think about, but Stephen and James are going to get into this in more detail as we go on. Deposit rates, maybe they're not, good enough. So as I said, Stephen and James will get into this in more detail. Threat of inflation. So, that can be a threat and a reason why you might decide to invest your money. Cost of living increases. Yeah, that's another reason. And then making your money work for you. So as I said, I just wanted to touch on those areas, but Stephen and James are going to get into more detail about it. Okay, from the financial planner's point of view, here are some things we'd like you just to think about, okay? How much money do you have available? I suppose what we typically see when people retire, and as I said, I can't stress enough about, taking your time with your decisions. But when somebody retires, things that we see often when they get their lump sum, their gratuity, the usual, I might change the car, or maybe I'll do the, change the white goods in the house. And people used to maybe go off on a cruise or a nice holiday. So hopefully they'll get back to that soon enough. Also maybe you give your kids a little bit of money, which is really nice to do, home renovations. So that's perfect. And obviously you need to have, money that's emergency cash that you can access, okay? So when we're sitting down with you, we'll help you assess, right, what are you going to need now in the short term, okay? But if you get to a space where you're like, okay, actually there's a bit of money left over, and I'm not going to have to access this between, maybe 2 and 5 years, that's when we can really help. One thing actually we were really blown away with by the profile of the person who has registered for this evening, because it's not just all people who are close to retirement. What we found is that over the last 14 months, our clients, a lot of our clients are saving more than ever. You're not going out spending the money at the restaurant at the weekend, and you're not going on the holiday. So actually, I know as a brokerage, we've done more saving plans and more investments than ever over the last year. And while I know we all hope to return to, a life where we're going out and about again, we feel that a lot of our clients have gotten really, really good saving habits. And so that's where we can actually help them. So yeah, as I said, the time frame. So if, we sit down with you and we discover, okay, actually, I have this pot of money here and I'm possibly not going to need it for 5 years. That's the space that we can possibly help with, okay? Other questions we'll be asking you is what are your primary objectives with this lump sum? What do you want to achieve from it? Will you need to draw any money from it during the period of time if it's invested? So that's another question you'll need to consider. Will you need access to the money? And then just other considerations, and this is kind of more in-depth if, when you're coming to a decision situation. Allocation of fund management. So that's basically what are the charges on the plan? Okay, so we need to talk to you about those. So, and is there an extra charge if I go into a more specialized fund? So yeah, we'll talk to you about that. Can I make additional contributions, when my money is invested? When I want to encash, what do I do and when can I do that? And God forbid if I died, what happens to the money? Taxation. So is there taxation on the interest that I get? And if so, when does that taxation occur? And if I do a plan and I do an investment, when will it be reviewed? So they're the kind of questions we would like you to think about in advance of sitting down with one of our financial planners. Okay, so without further ado, I mean, look, I think this is a really good opportunity. Stephen and James are absolute experts in their fields and typically will only really speak to broker market. So it's really great that they've taken the time this evening to talk to our clients directly about the areas that they are, they really know all about. So I'll hand you over.
Great. Thanks a million, Claire. I'm absolutely delighted to be here. You're very welcome. And look, it's great to be representing New Ireland Assurance, who I think, as you mentioned already, a lot of the people who are on the line will know New Ireland from the ABCs and the ABC contracts that they'll hold with New Ireland. But I think it's also safe to say that Irish Pension and Finance are actually one of the biggest financial advisors that operate with New Ireland in the investment space, both sort of before retirement and after retirement with their ARFs. So they're a very big important client, not only for New Ireland, but also in the public sector to give advice. So it's a great opportunity for us to chat to you today about investments. But I think you did touch on it there. It's important to note that New Ireland aren't the actual fund manager. We don't manage the money ourselves. Sorry, I'm going to take a drink of water here. We don't actually manage the money ourselves. So what we do is we'll go into the market and we'll go actually into the whole world of fund managers and see which is the best fund managers in what space. And we'll actually bring those fund managers then to Ireland and to savings and investment customers in Ireland. So we're delighted to have James Forbes here today from Goodbody Asset Management. As you said, he's head of investment solutions. So James, you're very welcome as well.
Thanks very much, Stephen. Delighted to be here this evening. Glad we're not sitting in sweltering heat, and people aren't feeling too guilty about sitting inside and listening to us this evening. But I'm delighted that there's so many have logged on to listen and talk and find out a little bit more about investments.
Indeed. And listen, Goodbody Asset Management have had some fantastic funds with New Ireland, and the performance of them has been excellent. So we'll touch on that as we go. I'll also be putting questions as we go to James, asking him questions, I suppose, that we'll all want the answers to. That's obviously the best place to put your money. We'll also have, as Claire said, we'll have a prize along the way. So don't be nipping out to put on a cup of tea, and because you might miss the answer to one of our questions. So we'll have to keep you tuned in and keep you on your toes. But without further ado, I'll just take you through the agenda. There's 4 topics that we want to cover off. We want to cover off. The first topic that we're going to look at is why invest. And funnily, there's 2 sides to investing, and there's an impact in taking too much risk in investing. Absolutely there is, and your capacity for risk and how much you feel comfortable with. But ironically, there's actually there's an impact in not taking enough risk, and that's nearly as important as taking too much risk. So we're actually going to just tease that out and just have a look at both sides of that risk spectrum. As Claire mentioned, we look at investment options. So we will look at the asset classes that you can invest in. And we'll look at those in a little bit of detail, and then we'll also look at the possible solutions. So if you take those different assets, what solutions are available, what type of products are available in the market, and James will have a look at a couple of his products that they have available, and I'll talk you through one of the products that New Ireland has available. And then finally, we'll just go to next steps. And I think this is probably the most important part of the presentation today is what do you do from now? And I think Claire touched on it. You need to take your time, and you need to look into this in detail, but you also need to get advice from somebody that you trust. And I think that's a very important part of investing. So going back, when you look at why invest, people, I think historically, when they thought about savings, they talked about investments, they're straight away, they would think, well, listen, savings, I'll go to the bank. So I thought that was a good place to start. So we just had a look at Irish bank deposit rates. And I just looked at them historically. And on the left-hand side, you'll see the rate of return that banks were willing to give investors or savers. At the bottom, you'll see the timeline. So back in 2008, back in the financial crisis, Irish banks were giving investors effectively 5% per annum on their investments, which was a phenomenal return, and everybody was very, very happy with that. But if you look at the trend, you'll see that 2011, 14, 17, you can see the trend has gone down to a point where we are now in 2021, where bank deposit rates are zero. They're basically not giving you any return on your money whatsoever. Now, banks are still a very good place to put your money if you need it in the short term. But if you're going to leave it there for any length of time and you're not getting any return, you just need to consider that. I think, I saw recently an article where they're actually charging people to take their money on deposit now over a certain level. So, it is something to consider, that it is quite, and I know, James, I think Goodbody have done a bit of work on this, and I know that you've looked at deposit rates. Like, is that trend going to continue? Are rates going to continue to be low?
Yeah, I think, Stephen, from what we see here is that even just after the financial crisis in 2011, the Irish banks were needing capital. So they were offering better rates than the rest of the Eurozone. And effectively, Irish deposit rates are set by the European Central Bank. And what they've been doing is lowering their rates. But, as the Irish banks then became better capitalized, the issue was they didn't need any more money from us as investors and savers. So what they did is they cut their rates, and as you rightly said there, in 2021 you're virtually getting nothing. And I think the other thing that a lot of savers have to just consider as well going forward is that the competition in the market is going to get less and less, because you probably read in the newspaper over the last number of months that Ulster Bank is pulling out and KBC are pulling out. So the options for us as savers in that marketplace has dramatically reduced. But effectively, at the end of the day, the deposit rates here in Ireland is set really by what happens in the European Central Bank. And this is a chart that just looks back at how the European Central Bank rate has virtually collapsed from about 3% per annum back in 2007. Then back in 2012, as we came out of the crisis, they lowered it to zero. And then, as you said, they've actually reduced it to negative. So if you're a large institution today around Europe and you need to put money overnight with the European Central Bank, they're going to charge you money for that. And that's what we're seeing here as well, a bit closer to home. We're actually seeing a lot of companies that maybe have spare cash, and the Irish banks are doing it firstly with companies. They're saying to the companies, if you've got whatever, let's say, 200,000, you're a big company and you're sitting there with 200,000 in cash, we're going to charge you for it. And what we're going to start to see over the next 12 months is that individual investors and savers will also probably get charged. And I think the other very important thing is, when we're listening to what the central bank governors are saying, and what their economists are saying, they expect these rates to stay low for the foreseeable future. So I think, out over the next couple of years, over the next 4 to 5 years, we're not going to see European deposit rates move much above zero. Okay, that's interesting. And to think like that, 20 odd years ago, interest rates were about 16%, and now you're talking at zero. It's amazing, really. So Claire touched on earlier as well that there are other threats to people who maybe choose not to invest. So if you choose to leave your money in the bank long term, you're not going to get a return on that money. So I went online and I found a slide here. It actually was quite difficult to find. For all of you like myself who've been locked away for the last year and a half, they are pints of Guinness. They're a rarity and only to be found in she beans around the country. But I'm looking forward to them coming back out. Now, I'm not suggesting that you invest in pints of Guinness, but I did look at the price of a pint of Guinness back in 1991 was the equivalent of €2. And today, the same pint, depending on where you get it, is about $5.50 on average. And really, the point I'm making about this is that this word inflation is really the increase in the price of goods and services. So if a pint of Guinness was €2 in 1991 and it's €5.50 now, you can see that the power of your money, your €2 then, has basically been whittled away, and you wouldn't even get a glass of Guinness for your €2 now. So if somebody, and I'm just thinking of examples of this, if somebody wanted to buy a house in 1990 for 50,000 and decided, okay, I'm going to buy a house, then decided, look, I'm not going to buy it, and they put the 50,000 under their mattress, and now they decided today to buy that house and they took the 50,000 out, they wouldn't be able to buy an extension onto a house. So I just think it's really important that if you are putting money away for the long term,
that you do get some sort of return on your money, because inflation is what's called the silent thief, that effectively it erodes the purchasing power of your money. So I think, again, James, you've looked at inflation in Goodbody and just looked at the impact of that. And would you share a couple of slides with us?
Yeah, of course, David. And what we're looking at here is that the impact that inflation might have on your savings. And I think, as you say there, I mean, if we thought of, maybe you're thinking about your children, and you're thinking of maybe want to help them on the property ladder, and wouldn't it be great if in 10 years time I could gift them 50,000 that you have, let's say you've got that money today, but you don't want to give it to them until 10 years time out. But if you have inflation running at 2%, the real value of that gift will have fallen to 41,000. So, you're not going to get as much value in 10 years time for that gift that you're given today. And the reason I used 2% there was because over the last 10 years in the Eurozone, inflation has been running at about 2%. But the big concern for a lot of investors today is that inflation is expected to pick up, particularly over the next 12 months. And even small increases in inflation can have a big impact in the value of your savings going forward. And what I've shown in the next two groups of bars, that in the middle there, you can see that if inflation was running at 3%, in 10 years time, that 50,000 would effectively be worth 37,000. So you can see the dramatic impact that it's actually having on your savings. And I don't think it will, but if inflation did get to 4%, then the value of that 50,000 in 10 years time would fall to about 33,000. So what we can see here is very, very important that, that we look, if we have savings and we're getting nothing for them in the bank, maybe we look at some other options to try to get a reasonable return with those savings over the next 5, 7, or 10 years time. And effectively, Steve, what we're trying to do here is look at options that might protect against that silent thief that you call inflation. And I suppose, looking at it, I mean, inflation, as I mentioned, was quite low over the last 10 years. But what we have seen is a dramatic increase, particularly over the last 12 months. And if you look at some of the commodity prices, they have risen dramatically. And a lot of that's due to what happened over the last 12 to 15 months or so. I mean, we all remember we had the pandemic, we had the lockdowns, economic activity across the world collapsed. If we think back to about this time last year, we were all broadly working from home. We weren't traveling very far. I certainly know if I filled the car up with diesel, it might have taken 6 weeks before I needed to go back and fill it up again. So the price of a lot of these commodities collapsed. But if you look at the price of those commodities today, as the economies start to open up, and particularly since the vaccines were announced last November, we've seen a massive rush for people looking for these commodities. Factories are starting to work again. There's more trucks on the road. We're using a lot more energy and fuel. So the price of oil has gone up by 87%, the price of copper by 86%. And one that might actually surprise you is the price of timber. It's up by 290%. So it's rocketed sky high, and timber's used an awful lot in buildings, particularly in house building. And in the States, it's causing a lot of problems. There's a lot of shortages there because people just can't get a hold of the timber or not prepared to pay the prices. But what we can clearly see is the price of a lot of these goods are going up. But that's just some of the what we would call the hard commodities. There's also the soft commodities. So if you think about maybe you're going back to the office in the next little while, and before you go into the office in the morning, you might drop into O'Brien's and grab your coffee and croissant. I mean, if you look at things like the price of wheat over the last year, up almost 50%. If you add your sugar on top of your coffee, up 44%, and your coffee beans alone are up 45%. So, I think it's fairly safe to say that, if you're thinking about going in and getting your croissant and your cappuccino, the price you pay today is going to be less than what you're going to be paying in 6 months' time. The price of that breakfast is certainly going to go up. And that's something that I think, investors, we need to protect ourselves against. And I suppose what we're also seeing is that a lot of these price increases are reflected in some concerns by investors. And what we look at is what are the expectations from a lot of investors. And what you see on this chart is inflation expectations in Germany. And if you look at this chart, and it goes back to 2009 at the time of the financial crisis, this is what investors expected inflation to do. And generally what you can see in this chart is that you sort of go from the top left and the chart goes all the way down, slopes downwards towards the right-hand side, and particularly hit very much a low about this time last year, whenever inflation expectation was only 0.5. So if you asked investors what were they expecting inflation to do in the next 5 years, they were saying, oh, it's only going to increase by 0.5 of 1%. If you ask those same investors today, what do they expect? They expect inflation to average about 1.5%. So that's the expectation. That's what the financial markets are telling us at the moment, is that as the price of all our goods go up, we can expect inflation also to tick up. And we know that as investors, that's not particularly good because inflation is eating away at our savings.
Sure. Looking at those increases, James, I think I'll skip breakfast.
Are you going to skip your Guinness?
No. So look, just even to summarize those couple of slides, because there's quite a lot in that. And I suppose what we're saying here is that, look, bank deposit rates are at all-time lows. And the bank is still, there's nothing wrong with the banks, building societies, credit unions. They are still good places to have your money, and especially money that you need access to in the short term. I suppose ultimately, if the price of goods and services are going up, it's just important that you consider, investing some of the money outside of the money you need in the short term in order to outstrip that loss of purchasing power in your money. So look, at this point, this is one of the exciting parts where we're going to have our question time, right? So our first voucher. So I'm going to give away the first voucher. It's a €100 one for all gift voucher, and as Claire mentioned and Sarah, we're going to do this through the chat box. So everybody, with your fingers on the pulse. The question is, and remember, it's the first person to get the right answer, and or nearest to the right answer. So New Ireland this year, would you believe, have a fund that has celebrated its 50th anniversary. It's a managed fund called Evergreen, and it's been around 50 years. But can anybody tell me what has the average return been every year for the last 49 years? So the average return. So the person with the nearest, and I can see a lot of numbers coming in here. So it's the average return per annum. So what's known as the annualized return. So we'll give that a minute to spin through.
We have a couple quite close, Stephen.
Certainly are.
Yes, Sarah's monitoring the.
What we decided to do here, because it is a, we're going to give the closest here, and I think, Sarah, are we going to cut it off at a?
Yeah, we can do. Yeah, give it a couple more seconds, just.
I can see people Googling it there. Hold on, you're not allowed to Google. So we'll call it.
I don't have any exact, but I can see one there quite close. So
4, 3, 2, 1.
And the winner is.
And the winner is.
So it looks like it's Louise Walsh. She had 8.5%.
Yeah, was there 2 8.5s? We might have to look at that.
Double check now.
This is costing more money, Stevie.
we'll have to have a playoff.
Yeah, I think Louise Walsh looks like it was the nearest. All right.
Well, look, we can take that offline. Yeah, the first one in. So we'll take that offline anyway.
There was 8.7.
Let me see now. I think that might be IPF staff there, Claire, trying to get a sneaky one in.
Oh.
Yeah, so no, I think looks like Louise, all right.
Okay, great. Okay.
Congratulations, Louise. Congratulations.
Well done.
So just the second part of the presentation is just to have a look at the investment options, to have a look at the various asset classes that there are to invest in, and then, how do you put those together? And how do you put them together to determine that, they're not too risky or they're the right amount of risk? So, James, I think you're just going to have a look at the various asset classes, Just maybe you might explain them briefly to us, and then how the risk would work depending on how you put those particular assets together.
Yeah, Stevie. So, typically these are the main building blocks that a lot of investors would look at to invest in over different periods of time. So, you'd start off with the cash deposits, and they often are either in the bank or in the credit union. Government bonds and corporate bonds, so these are just effectively loans that are issued by governments or companies. So if you think of a government like the Irish government, they might do a loan to investors for 10 years and they'll agree to pay a certain return. Now, those returns are very low at the moment, but what you can be guaranteed is that if you make that loan to the government, you actually get your money back again. So the risk there is quite low, albeit the returns can be quite low. Property, often a lot of people look at property funds, and they're typically commercial property funds. So they might be invested in some offices, they could be invested in retail. It's a fairly good way to diversify your risk if you're looking for exposure into property. Commodities, mentioned some of them earlier on in terms of the copper and oil, gold's another commodity that's in there that people often invest in. So what you can get is a mix of different types of commodities. And then finally, you've got equities or stocks and shares, as some people call them, but effectively they're companies which are quoted on stock markets that you or I can go out and buy a part of that company, and you own an equity or a share in that company. And they typically are the ones that are maybe a little bit more volatile. Their prices can move around a little bit more. So really what you have here is a range of investment options, or assets that we call them. And I suppose the key thing is that what you want to look to is how do you blend them in terms of risk. So, typically what you see is cash deposits, as we talked about earlier, are relatively low risk. If you give your money to one of the banks, there's almost a certain chance you're going to get that money back again, albeit you mightn't get too much interest on it. Where if you look at some of the other assets there's a little bit more volatility. But of course, the returns you get is linked to the risk. And I think that's a really crucial part, as investors, and particularly, when we talk to people, because everybody is absolutely different. So everybody's attitude to risk is different. Everybody's personal situation is different, and what their assets they have and what their plans are for the future. And I think that's what makes it all, quite, different, and why it's so important, that you actually talk to a financial advisor. Because what we would suggest to anyone is that you just don't go out and maybe pick one of these assets and invest in them and say, well, I want lower risk, so I'll go off and just invest in government bonds, say. What's the best solution for a lot of people is actually to blend them, or as I would call, work out what's the best way to create a jigsaw for yourself. And by putting these assets together, maybe in under one fund, what you get is less risk, but reasonable returns. And what you can do is that you can alter your exposure to some of these assets depending on what you're looking to try to do. So if you want something that, is going to give you, is fairly secure, then maybe you've got greater exposure into cash deposits and maybe some government bonds. But if you're looking for a reasonable return over the medium term, well, then the sort of fund that you might be looking to in the jigsaw there would have a greater exposure to equities, because generally over the medium to long term, they're most likely to give you a better return. But, when you mix all these assets together, the key thing to know and understand is what's your attitude to risk. And I think that's something very important. I think, Steve, you're going to talk a little bit about that as well at this stage.
Yeah, absolutely. Look, I think diversification is really key. It's very important because, as you said, if one of these assets is going up, maybe the other is going down. If one's going up, the other is going down. So you're looking to get, the best of both worlds, that you're getting that balance. I remember a business teacher explained it one time to me as it's like an ice cream van, a guy with an ice cream van at the park, and he sells ice cream, but he also sells umbrellas. So if it's raining, he sells the umbrellas. If it's sunny, he sells the ice cream. So he's doing well regardless of the weather. And I think that explains diversification. And as you say, like, understanding one's own attitude to risk, or your capacity for risk, is really, really important. And with any investments, it is a journey. So because you're taking that little bit more risk outside of your deposits, you will find that the journey is a little bit up and down, because markets do go up and down. And depending on your capacity for the downs and the ups will kind of determine how much risk you're prepared to take. Now, I think everybody was sent out a questionnaire, and I think, you know, if you take nothing else away from the presentation today, you know, have a look at that questionnaire, complete it, and send it back into Irish Pension Finance. They will then do up a very, very good report off the back of that will actually show you your attitude to risk, and will actually then put a blend of assets together that will suit that attitude to risk. So you'll see here that on the right hand side of the questionnaire here, it'll give you a scale of 1 to 7, 1 being very low risk and 7 being very high risk. Now, we very, very, very rarely have people that are in the very, very high risk, the very high risk 7 bracket. The majority of people, in fact, will find, depending on how long they have to invest the money, will end up between sort of 3 and 4 on average. But this is a very important exercise, that if you are considering to invest some of your money, that you do go through this process. And as I said, the team have got a very robust process. I've been through it with them myself. You complete the questionnaire, they build out a report, and it'll suit your capacity. You know, it'll suit you, because as James said, one size doesn't fit all. So you can't just say, oh, this fund is for you. You need to go through this process. You need to take time, and you need to assess this. But James, you've built funds within Goodbody. You know, I know you're head of that solution, and you know, we have taken you onto our platform because of these funds that you've built. Could you just take us through the 3 and 4 fund that you've built out? Maybe explain the way you've put together your assets within your particular fund, and then I know you have some protection measures within that fund as well that you might just touch on.
Yeah, absolutely, Steve. I mean, you're very right there. I mean, we've got funds that are risk category 3, risk category 4, risk category 5, and risk category 6. But most of the money that comes into us comes into risk category 3 and risk category 4. That's where broadly 80% of all the money comes in. So that's maybe where we'll focus in on this evening. So, you know, the first fund that we'll talk a little bit about is a fund called the Goodbody Dividend Income 3 Fund. So it's an ESMA 3. That's a 3 on that risk scale. And what it is, it's a multi-asset fund, and effectively multi-asset, as the name says, it has many assets within it. So what you see here on the left-hand side of the screen is the current asset mix of that fund. So it's got 40% exposed into dividend-paying companies or equities. So that's the exposure that we have to stock markets. But we pick out these quality companies that we believe are going to outperform the overall market over the next 5, 7, and 10 years. Then we've got about 22% in government bonds. These are mostly European governments, very safe, and we're in the Eurozone, so we don't take any currency risk there. We have about 19% in cash, 14% in corporate bonds. We have some property in there, and you'll also notice that we hold some gold, because often gold's a very good store of value, particularly if there's some inflation around. And then we've got some insurance, and that insurance is in the form of put protection. So we buy this insurance or puts, and what they do is that if equity markets go up, then the value of the puts go down. But if equity markets go down, the value of the puts go up, and they help compensate. So it's not a guarantee, but they smooth the journey for a lot of investors, and very unique in the Irish marketplace. And certainly, you know, when you look at these 2 funds, GDI 3 and GDI 4, they're the top performing funds in the market over the last 5 years. So they perform very strongly, both when markets are going up, but also when markets are going down. So that's the ESMA 3 fund. So for somebody looking perhaps for a little bit more of a return, we'd suggest you might consider the Goodbody Dividend Income 4 fund. Now, I'm going to say something here, and I hope you're paying attention, but this Goodbody Dividend Income 4 fund over the last 5 years has delivered 50%. So that isn't a guarantee of what it's going to do over the next 5 years, but 50% over the last 5 years has been very good, and certainly not a guarantee, but it's given people a reasonable rate of return, particularly when you compare it to inflation. But one of the key things you'll see in the difference between the fund on the left-hand side and Dividend Income 4 on the right-hand side is that it's got more exposure to these dividend-paying companies. So instead of 40% in the GDI 3, it's got 70%. So we've dialed it up slightly in the expectation that we're going to get a better return over the medium term. within this GDI4 fund. But as Stevie was saying a little earlier on, one of the key differentials of these funds is the insurance or the put options that we have within it, and that smooths the journey for a lot of investors. And you can see this in the next slide. If you think back just a little over 12 months ago, we were in the midst of the pandemic. Economies were being shut down. Companies didn't know if they were going to be around. Airlines weren't sure if they would ever fly again. Cruise ships were just put into port. Hotels weren't working. Nothing was happening. People were not spending money. Stock markets obviously reacted very badly. So the first quarter of last year was a particularly poor time for those invested in equity markets. Now, as I said before, probably the best way to move forward is to have diversification, not just to be all in equities, but to have these other asset classes as well. And this next slide just shows the performance of Goodbody Dividend Income 4 in the first quarter of last year. So if you look at the red bar, what you can see there is that global equity markets in the first quarter of last year fell 19%. So that's quite a significant fall. It wouldn't be good if you arrived and opened up your statement at the end of March last year and saw that the value of your investments had fallen by 19%. But if you look at the yellow bar, these are the companies that we invested in, and they actually went down by 9%. So they didn't go down as much as the overall market, albeit you're still down. And then we've got these other assets in there, which are our stabilizing assets. So we think of our REITs or our property companies, they were broadly flat. Our bonds, our corporate bonds and our government bonds, once again, they were broadly flat. And our gold actually went up in value. So they went up 0.4. But the big differential was this insurance contract or the put contracts. They rose by 7%. So overall, what you have is a fund that has a good exposure to these dividend paying companies, but the fund itself in the first quarter was down just 2.5%. And that's what we're trying to do with this fund, is smooth the journey for investors. So we're trying to say, we'll try and get you some of the upside as we travel along. But if markets do get volatile, what we hope to do is that we're going to smooth the downward journey as well, so that the overall journey becomes much smoother for investors. So once again, I think now at this stage, we're on to the second voucher, another 100 one for all voucher. And I think there's a good couple of hundred people on here now at this stage, and I'm hoping everybody was listening very carefully, because I talked about the Goodbody Dividend Income 4 fund, and I talked about its performance. And the question I have, what is the performance of the Goodbody Dividend Income 4 fund in the last 5 years?
Oh, they're straight in there.
Oh.
Yeah, they were very quick.
Yeah.
They were listening to you, James.
Ah, that's good.
I think the first one I can see there is Karina Bat.
That was quick.
Very quick.
Yeah, that was so easy, wasn't it? Make it far too easy. No, it's not my money.
You underestimated them, James.
She could take the €100 and invest in the Goodbody Dividend Income 4 fund. But look, these aren't just the only funds. I mean, New Ireland have a wide range of funds that are available, and there's different funds for everybody, as I mentioned earlier on, slightly different attitudes to risk. And I think, Stevie, you want to talk about a little bit about one of the funds that is also doing particularly well on the platform and attracts a lot of attention from investors.
Yeah, thanks, James. I tell you, I just want to touch on one fund. This fund has taken in over 300 million in the last 2.5 years. So it's a fund that's been, really, really popular. It's a fund that, like you mentioned there, it has a diversification of assets. So it has your equities, your shares, your property, your government bonds, etc., as you discussed. What makes it very, very unique, though, is that it has a capital protection built in. So the fund has an 85% capital protection of its highest ever fund value before any fees and charges. So I'll touch on that protection in a second. I'll just run through and just show you how it works. But this fund, it's liquid, so you can transfer in and out of it. If you don't like it after 6 months, after a month, after 5 years, you can transfer it out and in. So that makes it quite unique in that type of guaranteed space as well, where most funds that offer a guarantee, you will have to leave your money in for 5 years, something like that. So this one is actually liquid. It has a slightly different investment style than you have been discussing. So you talked about being active in the market and choosing specific equities, say for argument's sake, whereas what this fund does is it basically gives you and it tracks the performance of the market. So effectively you hold all of the stocks in the market. So it's called passive investing. And again, if you need more information on this, any of the financial advisors in Irish Pension and Finance will be able to take you through that. And the final kind of piece that and sort of risk management that this fund has is that when markets get volatile or get a little bit choppy, we will actually reduce down your exposure to the more riskier assets. And if markets then get less volatile and less choppy, we will actually dial back up your exposure to those assets. So it has a couple of layers of protection. It has the capital protection. It also has this volatility protection built in. And then just to have a look at the actual protection itself and show you how it works. So it's 85% of the highest value. So if you start off at 100, I mean, that's call this 100,000 for argument's sake, you're guaranteed 85%. You have a capital protection of 85%. If there's a calamity in the markets and a very strange situation happens, you cannot lose any more than 85%. But if the fund value rises to 110,000, you now have 85% of 110,000 as your capital protection. So it's 93.5% guaranteed. So that's locked in. So even if the fund then falls down to 95, you've still locked in your 93.5%. And if the fund value then rises back above the highest, which was 110, say up to 120, you now get 85% of the 120. So now you're at a guarantee of 102%. So it is an interesting fund, again, very unique in the Irish market. And the reason I brought it up is because it's slightly different than the other funds that we've spoken about. But as James mentioned, New Ireland, and indeed our competitors, as I said, Irish Pension and Finance are independent in this market. They can talk to you about any of the insurance companies and any of their products. So we're just giving you a flavour here today of the sort of options that are available. But again, most important is that you sit down, you go through the process, and you get the advice from the people who are prepared to take the time and that you can trust. James, just before we finished up, a couple of things. If you wouldn't mind just having a look, I know you have the fund performance here of the Sentinel fund that has the capital protection, and then also your own two funds, and just putting them up against sort of cash, and then the world equity index. So probably the most riskiest fund you can go into, probably cash being the least riskiest. But again, we spoke earlier on about inflation, so you might not necessarily want to be in that space for any length of time. But would you mind just taking us through that chart and just how Goodbody Asset Management saw the market at that time, and then I can see on it already that there's some big losses there.
Yes, Dave. So really what we've did here is gone back over the last 18 months or so, and we're looking really from the beginning of last year. And I'm going to try something here and draw on a chart, which I've never done before in a presentation, so this could be very dangerous. But you can see since the beginning of last year, this is the grey line here is the equity markets. So the equity markets did quite well, but then they had the collapse, and this is really the bit here that investors don't like. This grey bit down here when the equity markets went down, and in fact from the high to the low, the equity markets went down nearly 40%, so quite significant. So that's not something you want to do. Now, the other thing, though, what you do see, though, is that some of the funds that were available and that we were talking about actually performed quite well. So what you notice is that the funds didn't actually fall as much. So, for instance, if you look at the Sentinel fund, which is there in the sort of yellow, you can see the Sentinel fund went down marginally below zero and then started its modest recovery. And over the last 12 months or so has recovered quite well. Or if you look at something like, the Goodbody Dividend Income 4 fund, once again, it went down marginally below zero, but since then it has actually recovered quite well. And the Goodbody Dividend Income 4 fund since last year from the lows is up over 20%. So what we're trying to do in a lot of these situations is create a smoother journey for investors. And that's what we talk about, these smoother journeys, is so that we want to try and take the volatility out of the market for investors investors, so that you as investors or potential investors stay invested. Because the last thing we want to happen is that if you woke up and you saw the equity market down here and you might decide yourself, oh, I want to get out of equity markets. Well, that would have been the wrong time, because lo and behold, what happened, and nobody could have predicted what was going to happen down around here, but the market actually recovered, and recovered quite strongly. So what we want to try and do is smooth the journey ultimately for investors. Stevie, I think we had a couple of questions that come in there. Is there a few you want to have a look at?
So I think we had we've the questions that came in, the frequently asked questions that came in. So just I'll put them to you very quickly. So I suppose that there's two questions here, but I'm going to put them just into one particular question. So what would you advise, James, to do with a lump sum over the short term, and then, you know, on the flip side of that, what would you recommend to do with a lump sum over the longer term?
Yeah, we get that sort of question a lot of the time, Stevie. So I think if someone's talking about the short term, and that would be for me less than 3 years, I think, and if you might need that money at any stage during the 3 years, your options are actually quite limited. I think you'd have to be looking at putting it into a bank or into the credit union where you get instant access to it. I think that's the most sensible thing, because if it's for the rainy day, something unexpectedly happens, the car breaks down, you have to replace the car, it's the only way to get it. Because what you can't afford to happen is that if you were, let's say, in equities and you had a situation like the first quarter last year, you can't afford to lose money on that. However, I do think, if you're looking at the longer term, and that would be sort of 5+ years, and I would always say sort of more 7-year time frame, what I'd be suggesting there is that people look to invest in asset classes which can get a reasonable return and are always likely to outperform, particularly cash. And there I'd be saying look to increase your exposure to equities, and I think that's a good place to look at. So you might get a multi-asset fund that has a reasonable exposure to equities, but once again, I think the most important thing is to sit down with a financial advisor, discuss exactly what your requirements are, and then you fit the fund in around it. But certainly there's a big difference between looking at short term and more long term. And the other very important thing I would say, if somebody does have a lump sum, I think it's always very important to actually nearly break it into different segments. What you want to think about is, let's just say, an old aunt died or something, left you 100,000. I didn't have any of those aunts, by the way. But what you might do is consider, breaking it into short-term money that you might need. So you might take, you might say 20% of it is short-term. I'm going to need that money, and then you can break some into medium-term and then some into long-term. And the risk you take then with those different amounts of money can vary, depending on what your requirements are. And I think by blending it, it reduces your overall risk.
Yeah, I think that's good advice, to be honest. Another question here from Lady in Donegal. What would you recommend one does with your monthly children's allowance? So is there a place that you'd recommend that they'd invest, say, on a monthly, more regular basis, and in particular they've asked about the children's allowance?
Yeah, that's we actually come across that quite a lot. A lot of people actually say, they're fortunate if they're in a position they don't actually need the monthly allowance. I don't know where mine went. I had 3 kids. I never saw it, that's for sure. But I think there's two parts of that. The first thing is, the good thing is that you're investing monthly, so it's regular money going in. So you're investing regular. So if the market does go down a little bit, that doesn't matter, because if the market goes down, it's almost like you're buying something on sale. It's like, if you were thinking about the Christmas sales, you're getting a piece of the market a bit cheaper, today than it was last week. So you're getting something, and if you're buying it every month, it's a great way to do it. I suppose what I would say to this lady is what we need is a little bit more information, because we don't know what age the children are. So if the children are very young and they're not likely to need this money for, say, 10 years, well, then she can afford to take a little bit more exposure into assets like equities. But, if the children were, say, 15 or 16 and she wanted the money for them maybe going to college or something like that, I think, once again, you need to be careful that you don't, that you lower the risk somewhat so that you don't lose it. So once again, I think we need a little bit more information, but, I do think it's great if you can invest regularly, because if the market does have a dip, you can pick up some assets at cheap prices.
No, it's a good point. I think, investing regularly and investing in lump sum, that's a slightly different mindset. And then the final question I have here, and I don't know if Claire has any questions from the chat box or if they'd like to come in, but the last question here is around cryptocurrency. It's something obviously that has been in the news a huge amount, and I know Elon Musk has bought a load of cryptocurrency. So I just, again, it's a question that comes up quite a bit. You know, what's your view on cryptocurrency, and is it something that one should consider in an investment?
That's a tough one. I hope I'm not going to be held to this answer. It's very interesting. I've a 17-year-old son, and he came home last week, and he was talking to me, and he was saying, "Geez, Dad, the lads had a bad day." And I said, "What are you talking about?" He says, "Oh, the boys, you know, they lost 200 odd euro." I says, "What are they doing?" I says, "Oh, they're in Bitcoin." So when you've got 16 and 17-year-olds on apps trading Bitcoin, it sort of tells you something. But you know, I think, you know, with any of these cryptocurrencies, there's a couple of things really to take into consideration. The first thing is, they're most likely going to be very volatile, and we've seen that ourselves over the last 2 weeks. You know, the price of Bitcoin going from $63,000 down to the low $30,000 and then rebounding somewhat. So you're going to have a lot of volatility. So if you're going to invest in something like this, you need to be prepared almost to lose it all, and that's the first thing. I suppose the second thing is you're really trying to work out which of these currencies are going to be the winner, and I think that's quite a challenge. You know, you got to work out what exactly is the currency going to be used for. Will it actually, you know, get accepted? And I think, you know, that's the big question mark. You know, is Bitcoin the right one, or is it Ether? You know, there's proof of concept, all these different things coming through. So I think, you know, there's going to be potential winners, but picking out the actual winner could be very difficult. And then finally, you know, what we saw last week as well is, you know, there's a couple of other concerns. There's the environmental concern, and that really came to the fore last week, and that's what Elon Musk was talking about. But more importantly, we had the Chinese government come out and said that they're not going to allow Bitcoin. They said, no way, we can't control it, it's not going to happen. And we've also had some of the Federal Reserve governors also come out and saying they don't like it either. And I think I'll leave you with one last thing on the whole cryptocurrencies. As we all know here closer to home, we had the attacks on the HSE, and we've got all the files that are being held to ransom. And lo and behold, how do these international gangsters want to get paid? They want to get paid with Bitcoin. So it's sort of telling you what the use of Bitcoin is veering towards. And if it's veering in that direction, I certainly think that the regulators are going to have a closer look at it, and I think that'll increase the volatility. So I suppose really to wrap up, I personally have no idea where the value of these things are going to go. If anyone is considering investing in them, what I would suggest is, you know, it should only be a small part of your overall savings, and something that you're prepared potentially to lose every part of it, you know. So I think you've got to be very careful on that. But there's certainly likely to be volatility over the next few years.
Thanks, James. That was a comprehensive answer. I think I'll stick to the knitting, you know, and keep it simple. Look, just going to wrap up here. I think, you know, unless, as I said, anybody has any other questions, you know, I think I'm just going to wrap up with the last slide to say, I think the most important thing to take away from today is to talk to a financial advisor. Talk to a financial advisor that you trust. You know, and as I said, Irish Pension and Finance do a very robust process. I think Claire's taking you through it there, and it's well worth going through that process.
I'm going to put our contact details up in a second as well. We have one more voucher, Steve.
One more voucher. Happy to. Can I put an answer into that one? No?
Sorry, Steve.
Do establish your appetite for risk. You know, as I said, one size doesn't fit all. So it's just very important that you look at your capacity for risk, you look at the time frame, and you look at what you're comfortable with on that journey. Are you comfortable with a bumpy journey, or do you want the journey to be very smooth? And James showed you sort of returns that you can expect, you know, versus the sort of journey that you might need to go on. The next point is an important one. Reduce your risk by understanding your investments. I've spoken to a lot of people over the years, and I've asked them what they're invested in. And the answer is, well, sure, I'm in, you know, a fund with so-and-so, so-and-so. And I said, well, what's in the fund? I don't know. It's a fund, you know. So, you know, there's a saying that says, it's not the thing that's the thing, it's the thing behind the thing that's the thing. So you just need to actually understand what's under the bonnet. You know, take some time, as Claire said, to actually understand the investment. And then with that education, you will be more inclined then to stick the journey and take into consideration the ups and downs that you will need to in order to stick to your plan. So I think, Claire, that's
Yeah.
myself and James. Thanks very much
That's
for the
great.
opportunity today, and I
I'm just
hope people
gonna
get a bit of that.
do a couple more things here. Sorry, no, bear with me. Great. So what's going to happen next? I suppose it's the consultation process that Stephen and James, and thanks very much. That was really, really great information. So what happens next? It's your financial planner at IPF is going to do a fact find with you. And as James, was very importantly saying, identify your goals. We'll help you tease out what do I need in the short term, what will I need in the medium to long term. We'll do a risk assessment. So the 1 to 7 that Stephen showed you, we will have already sent you a risk questionnaire. So we'll get your report together. We can make recommendations. Then you can do an application process, but as well as that, what's really important is regular reviews. So that's the consultation process with Irish Pensions and Finance. So as I said, after this evening, Sarah is going to send over the slides to everybody, and one of our financial planners will be in touch to see, do you want to sit down and have a look at this consultation process? Okay, last question of the night. So Sarah Connolly, can we open up?
We can indeed, yeah.
Okay, so the question we have is, the value of 10,000 invested in a deposit account for the last 10 years will currently be worth 9,415. What would the value of 10,000 euros invested in a managed fund for the last 10 years be worth? So I have all the sources, etc. down there. So Sarah, you can see the chat function there, can you?
Indeed, yeah. So
I think we're going to do it to the closest 100 because...
Yeah, we won't look for the exact figure, but if we can get something close.
How are we getting on?
Okay, we won fairly close there. Let me see. Oh, yeah. Yeah, I think there's one, a Gerard. Now, we don't have a surname, but Gerard there went with 14.8, so I think he was probably closest.
Okay, do you want to close it off then?
Yeah, great. Okay, well done, Gerard. And actually, if the 3 winners could actually just pop us an email, just webinar@ipf.ie, and you can just let us know where you'd like us to send on your vouchers.
Great. Okay, so that was the answer was 14,660, by the way. Perfect. Well, look, as I said, I wanted to say thanks very much to Sarah Connolly for all the marketing support that she's done around the webinar. A big thank you to Stephen Dixon and James Forbes for giving their time this evening to explain, in a really understandable way, a lot of questions that I think our clients will have. And so I have all the contact details there. We have a special email address set up, Sarah, so anybody who's any queries can contact us at webinar@ipf.ie. You have our phone number, and also actually the number for our specialised retirement help desk is there as well. So thanks very much to everybody for attending this evening, and yeah, that's it, Sarah.
Yeah, thanks a million, guys. Thank you.
Thank you. Thanks, folks.
Thanks all.
Thanks a million.
Bye-bye.
Bye-bye.